What we're going to look at here with respect to adjusting journal entries, journalizing and posting them, we're going to apply, or these entries will actually be an application of the time period assumption and the accrual basis of accounting. Under the accrual basis of accounting, we worry about revenue and expense recognition. All right, so now, the trial balance that we looked at in Chapter 2 is what we call an unadjusted trial balance. It doesn't mean that there are errors in there. It just simply means that a lot of the accounts have not been updated for the end of the time period. Remember, we said the time period assumption simply means that you cannot determine the true profit of a business until it terminates. That's known as venture accounting. That's the way accounting used to be. You used to take on a venture, and at the end of the venture, you'd add up your expenses and count your revenues and find out how much you made. But because of environmental or societal needs, we have to report income periodically. So if we report income every month, we have to cut the period at the end of the month and determine the proper amount of revenue and expense at that time. And again, this is an application of the time period concept, revenue recognition, and of course, expense recognition. So that trial balance you see there is not necessarily incorrect, but it simply means that we have to come up with changes. So, for example, if you take a look at office supplies are up there at 500. Those are the office supplies at the beginning of the period. What could have happened during the period? You could have used up some of those supplies. And from a cost benefit, remember the term materiality. It's not cost beneficial. It's not material enough for you to subtract supplies every day. So every day that you use a toner cartridge, or every day that you use a box of pens, it's kind of silly for you to go in and make the adjustment. So you wait till the end of the period, whether it's a month, whether it's a quarter or a year, you wait till the end of that period and you make those adjustments. And the adjusting entries, what we're going to find are, again, if we think about the salary expense, we did that before, and of course we mentioned that you have these office supplies. But the most important thing to remember is that adjusting entries are made at the end of the period, and the second bullet is something I want you to focus on. It says that the events are internal events, which means that the adjusting entries are only made within the company. They do not involve anybody outside of the firm. Therefore, write this down 1,000 times. Adjusting entries do not involve cash. So if you're taking the exam and you see an adjusting entry and you select the choice where there's cash, it's wrong. I mean, you might as well just, forget it. It's wrong. There's no cash involved. There's no external transaction. So now, let's take the office supplies again. The beginning balance of office supplies shows 500, and we need to adjust that account. What's going to happen with the adjusting entries, we're going to make journal entries just like the one you see there. And the journal entries, you're going to find out, will always affect one balance sheet and one income statement account. So every adjusting entry we'll make will affect one balance sheet account and one income statement account. The balance sheet account cannot be cash. It's as simple as that. So it will always affect one balance sheet and one income statement account. Now, what we're going to find out is that if we go to, let me put this up wrong. Let's go to the ledger. Okay, so office supplies. And the balance of office supplies was 500. But we'll see this in the next slide. You've been using up lots of office supplies all year long. And let's say that at the end of the period, you counted the ending balance, and you take a count, and it only comes up to 100. So that means that you must have used up $100. So you have to, and I was mentioning this during office hours, you've got to think about ways, I mean, it's pretty easy, but you have to think about ways to analyze transactions, and using T accounts would certainly help. So the accounts that we're going to adjust here we know we're going to credit office supplies, and the debit goes to what? An expense. Office supplies expense. Remember, you have to affect one income statement and one balance sheet account. The office supplies account is what type of an account? It's an asset, and when the asset is used up, it's going to be expensed. So this usage is an expense. So the asset used up is an expense. So that when we now, and I'll get back to that if you need to see it again, but when we now look at the journal entry, we're going to debit office supplies or supplies expense and credit the office supplies. And one of the important things to note is that supplies expense was not an account in the trial balance. So you could actually create accounts in the adjustment process. So if you go back to that trial balance, you'll find out that there were no supplies expense on the trial balance. This account is created during the adjustment process. So you may have to open up accounts. Now, are these accounts just pulled out of the thin air? Well, no, they're coming from the chart of accounts. So go back, and again, the course always bills. So if you remember way back in Chapter 2, one of the first learning objectives was the chart of accounts. So in the chart of accounts, you could have a supplies expense, but you didn't use it yet. You're using it right now. So supplies expense is opened up in the adjusting process, and again, it is, of course, expensed, and we credit the office supplies. So now the balance, when you credit the office supplies, the balance is $400. Now, I said when we introduced the topic that we are going to relate this back to concepts. This relates to time period. It relates to the accrual basis of accounting, which is revenue and expense recognition. The time period assumption says that at the end of the month, I need to count up the supplies that are left and determine how many or what amount of supplies is expensed. The expense recognition principle here means that the expenses have to be recognized in the period in which revenue is generated. So you needed supplies. So let's say the supplies consisted of, it might have been, thumb drives, or might have been pens, whatever you needed to do your job. Those supplies were used up in the process of earning revenue. So we try to match cost with revenue as well. So if you take a look at the next slide again, it is relating to those concepts. And again, notice the second bullet, we're talking about cost benefit. We wait until the end of the period to make these adjustments. So you're not going to expense toner cartridges every time you use one. You're not going to take the expense of using a pen every time you take one out of the stock room or the supply room. You wait till the end of the period to count the supplies. In a factory setting, the textbook talks about, not necessarily charging for or using oil, you use oil up on a machine. You don't charge that every time you use it. So you wait until significant points are reached in the accounting process to come up with those adjusting entries. And other reasons for adjustments, just make sure you're familiar with these. Adjusting entries could be required because the passage of time, so that you may not have information available yet, or you may have to wait for the passage of time. So today during office hours, we set up a problem where we looked at insurance that was paid in advance. That insurance gets used up. It may not be matching exactly, but it's using the time period assumption. So let's say we assume we had insurance for 2 months. Every month we took 1/2 of that insurance policy and we expensed it. The other entries could be made, the adjustments could be needed because you don't have information. When do you get your utility bills? When do you get your cell phone bill? Comes in about the 15th or the 16th of the month. I know that a credit card, usually the billing cycle, your credit cards get, the bills get sent to you about the 15th of the month. The billing cycle stops at that point. So if I needed to prepare a set of financial statements as of the end of September, I may need to wait until October 15th to get all the information I need to prepare the statement. So I have no idea what my cell phone bill is at this point. I have to wait until October 15th to find out what my September charges were, and that's when I make the adjustment. So sometimes you just don't have enough information because the financial information is not available to you. All right, so are there any questions regarding the need for adjustments? So adjusting entries are needed because we need to apply the time period assumption. We have to recognize revenue in the appropriate periods. Sometimes it's based on the passage of time. Sometimes it's based on the need to wait for additional information. All right. Now, we're going to get a bit more detailed. And, of course, here's your summary. Again, just make sure you know, and I mentioned this as well, one balance sheet, one income statement, and no cash. Okay, now we're going to get a bit more detailed with this. And now we're going to talk about the different types of adjustments. There are two types of adjustments. They're called accruals and deferrals. And I'm going to define them in a second. But deferrals are like prepaids or unearned. A prepaid or deferred expense, a prepaid or an unearned revenue. Accruals are accrued revenues and accrued expenses. Now, to understand this, I think you need to be sure that you understand the definition. When you have an accrual, it means that an economic event occurs before a cash event. I'll give you an example. Interest in the bank. Interest on a certificate of deposit. Interest is accruing every day, but you don't have cash yet until the end of the month or until that interest is posted. So an accrual means that the economic event occurs before a cash event takes place. The same thing with utilities, the same thing with the utility bill I just mentioned to you. Right now, the university is using up lots of electricity in this room, but they haven't received the bill. They'll get that bill October 15th, but they are accruing expenses right now. So at some point when we get the bill, we're going to have to make sure that a certain portion of those utilities are accrued for the month of September. A deferral or a prepaid means that an economic event occurs before a cash event. Cash event comes first. So what happens? You collect cash in advance. Right? You got the cash, but you didn't provide service. There's no economic activity. You've got cash, no economic activity. What is that when you collect it in advance? A liability. You have a liability to perform services. Another type of deferral is where you pay for services up front. So what if you pay for insurance, you pay for rent, even a plant asset, even a building? When you buy that, you're prepaying for that service. So if you pay for it first, it's a deferred or a prepaid expense. When you use it up, it becomes an expense. So the example we had earlier with the office supplies are deferred. They're assets. You should understand also that when you see the word deferred, it pretty much means an asset for, prepaid assets if you pay it up front. And if you defer by collecting, it's a liability. Right? So if you collect first, it's a liability. If you pay first, it is an asset. So the explanations, again here, the two types of deferrals. You got your prepaid or deferred costs. Again, prior cash expenditures related to an asset that will be used up in the future to generate revenue. And that example, again, is office supplies. Unearned revenue is an advanced collection of cash that obligates you to perform some kind of a service at a later date. The accruals are going to be a little bit more difficult because you have to know your business and you have to have a little bit of business experience. So, for example, your experience with your cell phone is that, well, you're using it up, but you don't know how much, so you have to wait until the bill arrives. Now, typically, it may be more difficult to analyze because now you got to split the bill, right? So the bill is from September 15th to October 15th. So do you split it in half exactly? Do you go down the list and look at the charges? Maybe you can get it by date. So it's a lot more difficult sometimes to find out the exact amount of the accrual. All right, so now, let's go through some very specific examples. I want you to ask some questions as we go through this. And we're now going to take an example of a deferral. So these are deferred expenses. And the first deferred expense is prepaid rent. So in this example, this is the original transaction. This is the original transaction. The original transaction tells you that our company, Smart Touch Learning, goes out and pays 3 months rent in advance on December 1st. So they have an asset, they have a prepayment, they have a future economic benefit from using this office space, and they have it for 3 months. The problem is their year end or their month end is December 31st. So they paid $3,000 for 3 months, December, January, and February. But here's the problem. The problem for us with the time period assumption and matching and everything else is the following. We have to have what we call a cutoff, and we have to cut the period. And if that is, they paid this in let's just say they paid it in 2014 or 2013, let's say, and 2014. So this is December, and that's January and February. So the problem for us is that we have to come up with a clean cutoff with respect to that insurance. They paid it, or that prepaid rent. They paid it on December 1st. And they paid $3,000. And of course, the question is, how much of the asset is used? How much of the asset remains? So that when they go from December 1st to the end of the year, which is December 31st, 1/3 is used up. 1/3 of that is used up. And that means that 1/3 or 1,000 should be an expense. At the end of December, how much of the asset remains? If this is the beginning balance, I'll put a T account up in a second, and if they used up 1,000, that means at the end there's a balance of what? 2,000. So the asset goes from 3,000 on the unadjusted trial balance to 2,000 on the adjusted trial balance when we get there. So the first thing is you have to make sure somehow, some way, you get a picture in your mind visually as to time periods and as they get cut off. Okay? And in fact, in auditing, we do a lot of what we call cutoff tests. We have to make sure, when do we stop the transaction? When do we measure the event? And as you can imagine, if I'm doing this company's books for December of 2013, I've got to be hanging around their office for a couple of months, right? Does anyone know when financial statements get released? As of December 31st, you're not going to see those statements until somewhere in February, because the accountants and the systems analysts and everybody have to be around to make sure they know what the final numbers are. Not all those numbers are coming in at that moment. They don't come in at December 31st. You have to wait. So we have to have a precise cutoff on the amount of expenses and revenues. Now, yes?
The cutoff is only December 31st?
Yeah, that's the period I'm designating as my year end.
So like January and February
Would not, well, then when I do my statements for January, that becomes the next month.
Yeah.
Right. Or what if my year end was January 31st? It could be. Then my cutoff, so the cutoff is the end of the period. So the question is, what is the cutoff, or is it always December? It depends on the company's year end. So if I have a business that has a fiscal year end on December 31st, that's when I stop everything and measure revenue and expense. If it's January 31st, that's when I measure. If it's monthly, that's when I measure it. So you bring up a very good point, because when you're doing assignments, exams, and quizzes and everything else, you've got to read the question carefully. If they say the company is reporting monthly, then that cutoff becomes each month. Okay? So in this case, it wouldn't matter, because it happened to be a 1 month, anyway. But this is the balance. That's the expense. Now, what happens next year? How much do you use up in January? Another 1,000, and you use up another 1,000 in February. Right. But right now, as of December 31st, we're thinking about our adjustment. So again, just to get back to the transaction. So the account, prepaid rent, has $3,000 in the unadjusted trial balance. So once again, the unadjusted trial balance, it's not fraudulent, it's not erroneous, it's just not brought up to date. So we've got to bring that up to date for the amount that is used, and that information will be communicated to financial statement users. And to do this, as we said, we take 1/3, just to summarize, we take 1/3 of this, and again, if this is an adjusting entry, we said that we make adjustments by debiting one balance sheet, or at least by affecting one balance sheet and one income statement account without cash. Remember, these are internal transactions. They're not transacting with anyone. The original transaction, yeah, I paid the landlord or the owner of this property. I paid the $3,000. That was external. I wrote the check to somebody outside of my company. But right now, I'm sitting inside my company. The landlord doesn't care whether my year end is December 31st or February 28th. All we are concerned with now is the internal measurement of revenue and expense. So internally, we are measuring the 1/3 as the expense. So we have to debit rent expense and credit the prepaid rent. So right now, the journal entry, and once again, questions about entries during office hours, you got to be, unfortunately, following this format. You got to debit going to the margin, and you indent the credit. So you debit the rent expense and you credit the prepaid rent. And then right now, of course, you would take a balance right here. The balance would be what? $2,000. So going forward, the balance of that account would be $2,000. And then, of course, rent expense would be $1,000. So if I had to prepare a trial balance now, the corrected trial balance would show $2,000 of prepaid rent and $1,000 of rent expense. And it may very well be that the unadjusted trial balance did not have the rent expense on it at that point. All right, so any questions about this particular transaction? So it's just a matter of counting months and making sure that you allocate the expense to the appropriate period. Okay, so that is the first type of deferred or prepaid costs. Now, deferred or prepaid costs could be prepaid insurance, office supplies, and surprisingly, another prepaid or deferred is a plant asset. As I mentioned earlier, if you buy a building, or if you buy a piece of equipment, or you buy a car, you're actually prepaying for service. So we treat it the same way with some significant differences. So we're going to talk about the second type of deferral, and that's going to be a prepaid, which is in the form of a plant asset. In the plant asset, we have to essentially depreciate it. That's the term we use for the expense. So if you look at the diagram, it tells you that the asset is, of course, created when it's paid. So when you pay for the asset, you set it up as a plant asset, so maybe you debit equipment and credit cash. It's used up over time, and we're trying to measure expense to match with revenues. Now, this is a prepaid expense, but we normally don't look at it that way. We look at it more as a long-term asset. We don't think of it more as a prepaid. Prepaids are generally, it's the same thing, but the terminology is that this would be more of a plant asset, a long-term asset. So you would think of this as plant and equipment. Now, when you look at this, again, most of these prepaids, again, would be short-term. This is long-term. It acts the same way, but there's going to be some significant differences. When we made the adjustment a few minutes ago, we debited an expense and credited the asset directly. We're not going to credit the asset directly here. We're going to credit the account called accumulated depreciation. So let me get there. So what we're going to do when we make this adjustment is the adjusting entry is going to be a debit to what we call depreciation expense. And whatever that number may be, we'll get to that in a second. And we're going to credit an account called accumulated depreciation. Okay. All right, now, we don't credit the asset directly. So there's a couple of things I want to get here, or at least get straight here before we move ahead. So we debit an expense account called accumulated depreciation, and we credit, depreciation expense, we debit. we credit accumulated depreciation. Now, if this was office supplies, you'd be crediting the asset directly. We do not credit a plant asset directly. We credit accumulated depreciation. This account is known as, and this is all in the notes, but I want to make sure we see it together. It's called a contra asset account. And that account is used to reduce the asset. So if we look at the ledger, if we look at the ledger accounts, plant assets or asset accounts, what should their balance be? Normal balance of an asset is a debit balance. So the balance here is a debit. The question next is, how do you record that? What's the basis for recording a plant asset? It's at what? Historical cost. So that's the cost of the asset. And as the asset is used up and as the asset is generating revenue, as it's losing its value or as it's being reduced, we credit the accumulated depreciation. We credit accumulated depreciation. We don't credit the asset directly. So the asset is not credited directly. Now I'm going to explain why in just a moment. Okay, so we're not going to credit the asset directly. So when you reduce plant assets in the adjustment process, they are credited through the accumulated depreciation. So it's almost like what we did, if you remember, what we did with retained earnings, where expenses affect retained earnings a certain way. So really what this is doing is when you credit, anytime you credit accumulated depreciation, you reduce the assets. I'll say that again. Anytime you credit accumulated depreciation, you're reducing the asset. And on the balance sheet, yeah, yes. It could be, yeah. Plant assets could be the name of the account. You could have specific accounts like building or equipment or vehicles, okay? So we're just saying in general plant assets, but the question is, could you have specific accounts? Yeah, you could have an equipment account, you could have buildings, we'll show you that, you could have furniture and fixtures, etc. Okay, so any other questions before I get to the balance sheet value? Yes, sorry.
So is the reason why you don't credit plant assets because that will bring the cost of
Yeah, it's close. I'm going to get to that. Why don't we? We're going to do that right now. Why don't we credit the asset directly? So let me answer that question. The question is, why don't we credit the asset directly? The reason for it is close to what you said. The problem with depreciation is that, is it an exact number or is it an estimate, as we'll find out? It's an estimate. So because there are lots of estimates and assumptions and judgment used in the depreciation process, we don't want to give up the factual information that we have. So historical cost is factual. We know the number. The number is a number that we could verify. We can go back and look at invoices. We know how much we paid for the car. We know how much we paid for the building. So we don't want to distort the historical cost. So we accumulate the estimate in accumulated depreciation. So what we're trying to do is preserve the factual information that we have. And the other reason for it is the significance of the plant asset. You know, a building could be a couple of $1 million where office supplies could be $400 or $500. Yep. Yeah, that's what we said. You know, we would, the question is, if you had more than one asset, Internally, would you depreciate them separately? Yes. You'd have furniture and fixtures, accumulated depreciation, furniture and fixtures. You'd have building and accumulated depreciation on the building. Now, the only thing we don't depreciate is land, generally. Land usually goes up in value, so we don't depreciate that. In some parts of the country, you would if you were farming, and if the reason why you're using the land is to farm and it gets used up, or when you have mining, you're obviously if you use up the property, it could depreciate that way as well. Yes. This is all deferred, yeah. I mean, because the plant assets are a deferred cost. Okay, so it's part of your deferrals. Yep. All right, so let me just do this, and then we'll get back to an example. So what I wanted to remind you is that on the balance sheet, and let me write that in here, you can look at the plant asset as a deferred cost as well. The net book value of the asset is going to be the cost of the asset okay. So on the balance sheet, you're always, and this to answer your question, yes, it's a deferred cost. So on the balance sheet, it's always going to be that the net book value, let me get over here so you can see it, the net book value is the cost of the plant asset minus accumulated depreciation. The cost stays constant for the most part, and the accumulated depreciation goes up as you use the asset, and the book value declines. And that's the process that we use instead of crediting the asset directly. Okay. Okay. Now, we have this in the notes. I'll point that out to you in a second. All right, so that's the process for depreciation. Now, I mentioned the term here, value. It says net book value. You have to be careful. So if you go back to the slide that talks about allocation, what I want you to be aware of is that this is really a process of allocating the cost to the future periods of benefit over the estimated life of the asset. This is on 48. I'm sorry, 48. Or is it 58? 58, I'm sorry. Can't see it. Okay, so this basically, if you look at the term here, allocation, what I want you to realize is that you're allocating the cost, you're not valuing the asset. So when I use the term net book value before, don't think that's the market value. We don't use market values in a lot of cases, and in fact, we don't use market value for plant assets for sure. It's simply the original cost. So if you paid $1 million for that building 30 years ago, that's what goes on the balance sheet minus the accumulated depreciation. So there's no value there that relates to market value. It's book value. Book value means what you recorded it at. It is not based on the market. So it's a process of allocation, and it is not valuation. In addition, again, the adjusting entry, as we said, just to review, you debit depreciation expense and you credit the accumulated. And again, it's not recorded against the asset account. In addition, what we said was that this would be a net balance on the balance sheet. So you always take the plant asset and subtract out the accumulated depreciation to get its net book value. And once again, we use the contra account mainly because of the fact that it is an estimate. Okay, so depreciation is an estimate. So to summarize, depreciation is a process of allocating cost against revenue. We make an adjusting entry by debiting depreciation expense and crediting the accumulated. Land is never depreciated, and again, you have to think about this idea of a contra asset account. The contra asset account has a credit balance. It increases by a credit. What's the normal balance, by the way, of that account? What's the normal balance of Credit, right. So accumulated depreciation goes up by a credit, and its normal balance is going to be a credit balance. All right, so now let's take an example. This is an illustration which someone asked me a question the other day about this, and this is a good way to at least make sure I answer that question for everybody. What do you do if you buy an asset by issuing stock, or assets are acquired by a contribution from a stockholder? Well, essentially, if a stockholder contributes furniture in exchange for common stock, you don't necessarily have to use cash all the time. But the point is, the asset goes on the books at its cost at that point. So it's a debit to the furniture for $18,000, and we credit common stock. You normally would credit cash. Now, how do we know how long the asset's going to last? Well, again, it's going to be an estimate. So all of this is estimated, and we'd have to think about how we use the asset. Everybody would have a different useful life. If all of us buy the same car, it'll last for different periods depending on who's driving it, how we're driving it. Are we using it for business? Are we using it for personal use? So we have to come up with an estimated useful life. It also has no scrap or residual value in this case. And what is a scrap or residual value? Well, explaining this today in office hours, if you were going to buy a car for $30,000, you would think about maybe trading it in. So in 5 years from now, how much could you get for the car? Maybe $5,000, maybe $7,000. That's its residual value. So when you look at depreciation, there are lots of estimates. Number one, you have to estimate its life. Secondly, you have to estimate its residual or scrap value. What are you going to get when you turn the asset back in? How much value is it going to be worth in 5 years? If anyone leases a car, the residual value is on the lease. If you've ever seen anyone have an auto lease, if you've seen an auto lease, if you look down towards the bottom, there's a number typed in there. That number is the residual value. That's the number the dealer expects to retrieve when you bring that car back. So that's the scrap or the residual. All assets have residual values. So the two estimates so far are useful life, scrap value. Now you got another one, and that's depreciation method. We're going to use, at least for now, a depreciation method known as the straight line method of depreciation. It is an estimated allocation process. It is not very, realistic, but it is in fact something that is used quite a bit in practice. So if you have an $18,000 asset, and if you think that asset's going to last for 5 years without a residual, the asset would depreciate $36,000 per year. Now, the reason why, if you think about the terminology, if you look at a diagram of depreciation expense, and the asset's going to last for 5 years, that's where we get the term straight line from. In other words, we're going to take $36,000 per year. Now, again, it's unrealistic in a lot of ways because you're assuming that the asset is used the same way every year, and that's not necessarily true. What would be more likely the case? You buy a new car, what do? You drive it more up front, correct? You buy a new machine, you produce more with it early on. So probably this is not essentially a good way to match cost with revenue, correct? Because you're probably doing what? You're probably using it a lot more up front, and you should be charging more expense. But this is a simple way to estimate it. And by the way, that's why you really want to have the cost of the asset preserved. You want to make sure that the asset is in fact maintained separately from the estimate. And then of course, if you wanted to do this monthly, you would divide that by 12, and you would get the monthly depreciation of $300 per month. So that's per year, and that's per month. So that's how much depreciation per month that you would be taking. Now, when we now look at the asset, let's go back to some of the other issues we looked at with this account. When this asset was first acquired, and this was, again, for the furniture. And now let's get to the specifics. The furniture account. And now to answer the questions we had, you have a separate accumulated depreciation account for the furniture. Okay? So the beginning balance, or when the asset was purchased, so the asset was purchased on December 1st or December 2nd. Okay? So there's your asset, and that's at cost. Just to remind you, that's historical cost. Now, the accumulated depreciation is the contra account. So as that asset is going to be used up, we're going to take $300 per month, and we're going to reduce the asset by increasing the accumulated depreciation account. Okay. So let's take a look at the entries. I'll bring that back up in a second. Any questions on the depreciation calculation? So right now you're only responsible for straight line. A few chapters from now we're going to hit other methods. Okay. Any questions before I go on? Any questions about the T accounts or the ledger accounts, the way they will appear? Any questions before we move ahead? All right, so now we're going to book the depreciation. The journal entry would debit the depreciation expense for $300 for the month of December. And again, that's the cutoff. I'm accounting for this company on a monthly basis, or if it was the end of the year, I would also have the same cutoff. So I have a debit to depreciation expense and a credit to accumulated depreciation. Now, as part of the adjusting entry, I'm going to credit the T account. So let's see how this is going to work. Essentially, let me get this on. That becomes the net book value. If you look at the next slide, which I'll put up in a second, it tells you that the net book value or net asset value is the difference between the cost and the accumulated depreciation. And again, the rationale or the explanation as to why we want to use the accumulated depreciation, it's to preserve the historical cost. So you don't want to, in any way, you don't want to distort the historical cost number. You want to make sure that you preserve the $18,000. I can find an invoice for $18,000 somewhere. Depreciation is only an estimate, and you can change that estimate too. Yeah, Amir? And I'll repeat the question.
Depreciation expense $300. So wouldn't you need to make another account to debit that?
Oh yeah, there would be. I'm just not showing you that, but let's do that if you wanted to. This is the.
Then if you do that, then it still adds up to the furniture that you bought $18,000.
Well, let's see. Let me just get your question for the. I guess you're asking for the depreciation expense. So yeah, in the journal entry, that would be $300. That's correct. So the adjustment would be a debit to depreciation expense, a credit to the accumulated. Okay. Right, and that'll balance out because the equipment was there already. The furniture was there. What was the balancing entry to the furniture? There was a credit to common stock. I just didn't show you that, but yep.
No, because I thought that since the debit was there, I thought that it would equal it.
Yeah, no, that's you'd have to debit the depreciation expense too. Yep, in the ledger. Okay. All right. So again, as I said, if you go to the next slide, you'll see that once again that's the net book value, the difference between the two, and the contra account again is used, as I said, to make sure that we preserve the historical cost. All right. Now, let's see how accumulated works, because there's a big difference between accumulated depreciation and the depreciation expense. If you go to, let me just cover this up here. If you go to this slide, what you really need to understand at this point is the way in which accumulated depreciation works. It is a balance sheet account. It accumulates period after period, so that in December, January, and February of the next 3 months, you're going to have, and I'm going to put this up on the screen in a second, you're going to have 900 at the end of February in accumulated depreciation. So that at this point, the net book value on the balance sheet is 17.1. Let me show you how that is going to look in terms of the T accounts. What would happen is that if you wanted to get a set of financial statements as of the end of February in 2015, your asset account did not change. That's historical cost. But you've got accumulated depreciation, December, January, and February, and that's what we mean by accumulated. It means that it builds up or it adds up. So that the net book value here, if I just move this over a little bit, if you wanted to see the net book value, I'll just abbreviate it. Net book value is equal to 17.1. And that's what's on the balance sheet. Yeah. Yeah, if it's straight line and you have no other information, the question is, does depreciation stay at the same rate? If you have no other information, you assume that we keep taking 300. Now that could change. You could change your estimate. What if you bought a car and you thought it was going to last 10 years, and then after 4 or 5 years, you realize it's breaking down and you have to sell it or you have to scrap it? You may change its useful life and say, well, now instead of lasting 10, it's only going to last 6. So that could change. Yeah. So yeah, I mean, if I was doing a formal T account, this would be, this would be December, that would be January, and that would be February. Right? In fact, that's what you're seeing, right here. You're seeing on this account, sorry about that, that didn't come, on this account, that's the way you would see it, right? But I wanted you to see the perspective here of the way the balance sheet would look. So the balance sheet would show 2 accounts. It would have furniture and the contra account accumulated depreciation. Now, here's a question for you. If I'm preparing a balance sheet right now and I've got plant assets with accumulated depreciation is a credit balance. Does it go on the asset side or the liability and equity side of the balance sheet? Asset. It stays on the asset side because these accounts are related and they can't be separated in financial reporting. So the plant asset and the accumulated cannot be separated in the financial reporting process. So even though it's got a credit balance, it's not shown on the liability side. So the accumulated depreciation is shown with the asset. They're always together. So you can't separate these. They're one unit on the balance sheet. Okay. All right, there was another question here, I think, or you got it? Okay. All right, so again, it would be, even though it's it has a credit balance, it is still part of the asset. So it's all together. You'd have to report these together. Okay. So those are examples of deferred cost. You've got prepaids, that's one case, the longer-term asset, the plant asset. Any questions on this? Now, again, you've got to be able to measure properly when you look at these questions, the dates and when the expense has to be measured. Yeah, Amir?
The balance sheet with the furniture be 17.1 or just that?
No, you'd see 2 accounts. You could, So, right. So you'd see on the balance sheet, you'd see furniture, and then underneath that, accumulated. Okay? All right, now, let's just summarize this. Sorry about that. All right. So let's summarize what we mean by deferred costs. All right. First, if you look at the way the arrows are going, number 1, you have an original cost, an expenditure that could be your cash outflow, for example. On the balance sheet, you record it as an asset. The term capitalize also is the same thing as deferred or prepaid. If you say you capitalize a cost, it means it goes into an asset. Capitalization means going into an asset. So it's a prepaid, deferred, unexpired cost. As the expenses are used up or consumed, they swing this way. So if you look at the flow, it goes from the cost into the asset account, and then it swings into the expense as it's used up. Now, before you make the adjustment, the assets are understated overstated and expenses are understated. So if you look at prior to the adjustment, assets are too high. So for example, when we took our depreciation off the asset, that means that it is going to be reduced. Before we take the depreciation, it's going to be too high and we have to adjust it, and the expenses are understated. The adjustment always results in a debit to an expense and a credit to an asset. Here, just make sure you add credit to a contra asset as well. All right, so it could be a contra asset as well. So again, the first point, assets are going to be overstated, expenses understated. The debit goes to the expense. The credit either goes to an asset directly or a contra asset in the case of accumulated depreciation. And your examples would include supplies, insurance, rent that's prepaid, and of course depreciation. Okay. So those are deferred costs or deferred expenses. Any questions on a deferred cost or a deferred prepaid type of an expense? All right, the last type of deferral is the unearned revenue, and this is an advance collection. So you have to remember, this arises when a company gets payment in advance of providing services. They're also called deferred credits. Once you accept payment, you have an obligation to a third party to provide goods and services to that company. So let's take an example. And let's say that on December 21st, we have our company Smart Touch Learning provides online learning services for a law firm, and it's going to be provided over the next 30 days, but they collect $600 in advance. On the day they collect that payment, you have a debit to cash and a credit to unearned revenue. Now again, lots of questions today in the office about accrual basis of accounting, cash basis. We're not on the cash basis, we're on an accrual basis, which means that if I collect money but don't provide economic benefit to the other party, I've got a liability. So even though you collect cash, you still owe somebody a service. Just like if someone said to you, okay, what, you're working for me next week, let me pay you right now. That's not income. That is essentially a liability. So if you get paid in advance, that is a liability, and that liability in this case is going to be $600. Now, when the liability is on the books, of course, it stays there until you provide the services. So let's assume that, and again, we'd have to tell you how much of the service is provided. So we're assuming that from December 21st to December 31st, they provided 1/3 of that service, so they earned $200. The other 2/3, or the $400, is not earned. So to recognize this, we have to debit the unearned revenue and credit the revenue earned for $200. So again, we're going to tell you how much is earned in this case, and that means the balance is unearned, or the $400. So in this case, what you would have to do is debit the unearned revenue. So let's do that first, so that we're giving you that number. So we're telling you out of that $600, 1/3 or $200 is earned. So you have $200 debit to unearned revenue, and you credit service revenue for the balance, or for the credit of $200. Now the balance of that account is what? $400. You don't see it here, but that's because the slide, or at least the publisher, is not taking the balance, but you take the balance here of $400. That $400 is a liability, and that stays on your balance sheet. You still owe someone for 2/3 of the services that you promised to provide. So again, you still have a liability of $400. So again, that is going to be a balance of the obligation of $400, and then of course the revenue is now going to be added onto the balance sheet. So at the end of the year, you now have to add $200 of service revenue. So the journal entry is going to be to debit the unearned revenue and credit the service revenue. A couple of things: make sure you always look at the balances of these accounts. Does it make sense? When you look at this, do like a reality check or a sanity check. Make sure that the numbers are reasonable. So after you're done and you look at that T account balance and you see there's $400 left, does it make sense? Well, right, if I still owe somebody 2/3 of the $600 upfront payment, I still have a liability of $400. If I earned 1/3 or 1/3 of the 6, I know I've got a service revenue of 2. Okay. All right, so now to summarize the deferred revenues, it appears, as you see it up on the screen, you've got a cash paid or collected in advance. So you've got an advance collection initially recorded as a liability. We're not going to do the appendix, incidentally. You can look at that if you want. I mean, it's possible that you could record these in the opposite way, but we're going to stay with this approach where instead of recording it, you could record it as a revenue but then adjust it. It's I guess, more systematic to do it the way we're doing it here. So you've got cash received in advance. That immediately goes to the liability account, and then as delivery takes place or as services are performed, it then becomes a revenue. So again, always thinking about one balance sheet and one income statement account in the adjustment process. Internal transactions, no cash. Prior to the adjustment, your liabilities are overstated, revenues understated. You got too much of a liability if you provided the service. You got to bring that down and recognize the service that you provided is in fact now revenue earned. The entry debits the liability, credits revenue, and examples would be rent, magazine subscriptions, season tickets, anything that you collect in advance and you owe service to the individual or the third party. Now, the next is going to be accruals. And you're going to find that the actual adjustments here may be easier, but they're not as easy to identify. Let's start with accrued expenses. What are accrued expenses? These are expenses that you've incurred, they're unpaid and unrecorded at the end of the accounting period. So let me summarize that for you. If you have an accrued expense, by definition, it's an expense that is incurred, unpaid, and unrecorded at the end of the accounting period. So it's an expense incurred under the accrual basis. It's not paid. So again, for those of you that are still confused about cash accounting, I don't care if you didn't pay it. It's still an expense, and it has not been recorded. So there's nothing recorded on the financial statements, and you'd have to come up with that. And then, by the way, this is either with the passage of time or, you have no bill yet for utilities, something is unknown at this point, but when you find out, once you get the bill, you have to record it. Okay. Now, let's take a look at an example. Let's assume that you have our Smart Touch Learning. We'll put this up on the screen, of course. And they're going to pay a monthly salary of $2,400. Now, the way they pay it is a little bit strange. They pay it on the 15th of the month, but the first day of the next month. So the way it will work is that you're going to have a very interesting looking calendar because December 31st, which is the last day of the year, falls on a Wednesday, and therefore the last time they paid an employee was on the 15th of the month. So the way this would look, and we'll show you the calendar in a second. Move this up a little bit. Okay, so the way this would look is that this is on December 31st. So they paid half the salary here. So they're good to go, right? They've already paid that. But over here, on January 1st, they owe another $1,200. But the question is, when was that salary earned, and when did you incur the expense? That's the question. you incurred that expense over this 15-day period. So in here, you have an accrued expense of $1,200. So you have an accrued expense of $1,200. That's when the service took place. So over that timeline, somebody worked for you for 15 days, and you owe them that salary. So again, as I said, it's sometimes it's a little bit easier to make the entry because it hasn't been recorded. And what I mean by it's easier to make the entry, you don't have to look at another account, right? You know, we had to mess around with, depreciation. We had to mess around with office supplies. Oh, let's see what's in that account, right? You have to kind of see what's in there first and then adjust it. Here, there's nothing to worry about. You don't have to look at anything. You just flat out owe this person $1,200, and that's it. So you make a very simple entry. And in fact, let me just show you again with the calendar. It's clear with the calendar, of course, you paid someone on the 15th. I like timelines, but the calendar shows you on the 15th they paid last time, and they're not going to pay them again until January 1. So you owe them all that pay. But the economic activity was provided to you. You took those services, and you didn't pay them. So again, you got to make the entry, which is going to debit salary expense and credit salaries payable. You don't have to look at anything. You don't have to worry about office supplies, whether prepaid rent was paid 2 months ago or 3 months ago, or insurance. These are very easy adjustments in terms of debits and credits. The problem is figuring out the days, counting the number of months, figuring out where the cutoff belongs. That's the tougher part in this case. So when you look at this entry, very simple. You debit the salary expense, you owe for that, and you credit salaries payable. So that's your accrued example of an accrued expense. The same thing would happen with utilities. The last time you paid utilities was going to be on the 15th of the month. You get a bill, January 15th, you got to sort of backtrack and figure out how much of that belongs in December. And that's kind of the tough part of the process. All right, so does anyone have a question here? Yes? Yeah, which one? I'll go back. Sure. Oh, you mean on the document camera? Sure, there you go. Sure. Okay. All right, so again, I personally like to do it this way, just so I sort of know the cutoff. And here, by the way, this is our, when you look at that's the end of the period, and that's when you got to make that entry. Okay, are there any other questions? You got it? Is that okay? Yep, thanks. Sure. I'll repeat the question, yes. Sure. I'm sorry, start that again? Yeah.
Is the accrued expense actually a period conception?
Time period concept, yes.
It's a period conception. So can I say that
And I'll repeat it, yep.
during December 15th to December 31st, the company has accrued expense every day and it accumulated.
Exactly right, yeah. Right, okay, so let me repeat this. All right, so definitely the question was, is this an application of the time period concept? Yes. It's also an application of the matching concept, which I'll tell you in a second. But the application of the time period concept means that every single day you accrued one more day of salary. Now again, from a materiality perspective or a cost-benefit perspective, it doesn't make sense to sit there and start booking salaries every day as an expense. You wait until the payday. It's also a matching because you provided services for 15 days and hopefully you did something to raise revenue for my company. Right, so I'm matching your expense against those revenues. Okay. All right, any other questions? Okay. Now I'm going to summarize this. If you go to the next. Here's the way it works. Don't look at that big blue arrow for a second. But again, simultaneously, once you look at your records and you find an expense that's incurred in advance of cash payment, and as I said, accruals mean that an economic event, which was, as you said, salaries every day, these economic events are taking place, you owe them for those salaries, economic event occurs before the cash event, you simply need to debit the expense on the income statement and credit the liability, no cash flow. You only record the cash disbursement when the payable is paid, and that would be when, in our example, January 1st. So there's no cash involved until you actually pay it. And again, prior to the adjustment, the event is unrecorded so that you have both liabilities and expenses are understated, and of course you debit the expense and credit the liability account. Okay. Now, one more example, and that is an accrued revenue. So accrued revenues, these are also, I think, a lot easier, but let's go to the definition. Oops. So accrued revenues are revenues that are earned they're uncollected and unrecorded at the end of the accounting period. So they're earned, they're accrued in the sense that you earned the revenue, you didn't collect them yet, no cash, and they're unrecorded, which means you have to make the adjusting entry. Example, you provided services, you didn't send out the bill, right? You provided services, didn't send out the bill. Or it could be passive income like interest. You got interest accruing in the bank, you didn't get your bank statement yet. The bank statement comes in, and you know you earned some revenue. Okay. All right, so let's go to the example. This is on, bring that up for you. Everyone okay with this? You need any more time, or you have any questions on that? Okay. On the example, it tells you that Smart Touch Learning agrees to provide e-services for $1,600 per month, but it has not been paid for its services. At the end of December, it actually found out that it provided one half of the services. So very simply, what do? You debit the accounts receivable and credit service revenue. In the event, for example, that same thing, what would happen if you get a bank statement on December 31st and you found out that you have another $1,000 in interest? What would you do? You would debit interest receivable and credit interest revenue. You didn't collect it yet or didn't pull it out yet. So again, you would have an asset and a revenue without any cash. So once again, let's go to the diagram. Again, these are pretty simple. You got revenue earned in advance of cash receipt, and the first thing you would do is debit the receivable and credit the income statement revenue. There's no cash flow until the receipt in the next accounting period. And again, since the event is unrecorded, the asset is understated and the revenue is also understated. The entry will be a debit to an asset account and a credit to the revenue account. Okay. Now, a couple of questions to ask you before you go, and I guess my official timekeeper, what do you have? We still have time, okay. Okay, official time, we got 3 minutes, time for 3 questions. The last question is typically, are you still here? But that's okay, because I'll get you on the last question. All right, so let's go. All right, by the way, there's a summary. There's also another good summary there for you on accrued revenues. Okay. All right, so here's one. We'll start off with an easy one. Accrued revenue is income that has been received in cash but not yet earned. All right, there's minute number 1. That's your first minute. Okay. All right, let's see what we got. Okay, good. All right, the answer, of course, is B. All right, if you again, we have 2 more to go. If you answered A, you just You just reversed the logic. So an accrued revenue is revenue that's been earned but not yet received.